The coastal areas of our major urban areas are going to do absolutely great, as will traditional blue chip urban areas, middle and inner ring suburbs of our major cities. They're going to do really, really well. Welcome to the Urban Property Investor. I'm your host, Sam Saggers, here to help you crack the code of real estate wealth. Today's show, we're going to dig into taking on a little bit more risk in our property portfolio, maybe jazz it up a bit. We're going to talk about some concepts on how I'm going to invest when it comes to property investment. We're going to talk about dumbbell investing. Yes, do you lift weights? If you lift weights, you know what a dumbbell is. And today we're going to apply that principle to investment. But hey, welcome back, regulars. You know the drill. Play the program in double speed, get your life back. And of course, all the episodes are done are lessons on real estate, so feel free to go back in time. But hey, life is good. One of my neighbors is moving back. Yes, a neighbor who moved out of her house, went away for a couple of years, is returning to live next door to the gospodar. And this neighbor is an absolute party animal. So we're all a bit, perplexed as to what next. She's wild. She's been known to crash her car into your car parked in your own driveway. So we're all excited that she's returning. It should be good fun around here. There are rumors She really does participate in a lot of weird stuff. So, hey, that's all good. Keep it alive. Better than the gospodar. Better than the leaf blower. Give me the party over the leaf blower any day. But hey, life is good here. I hope life is good where you are. We're going to talk about adding some risk to your portfolio, particularly if you've got a level of wealth to take on a what next. I was speaking to one of my clients, Lee. He's an awesome fella. He's bought bucket loads of real estate through our investment firm. And he's made a lot of money, which is great. And he sort of reached out, what next? What does he do next? He's got sizable amount of money. How should he invest? I actually think Lee should invest very similar to how I'm investing, because once you reach a certain level of wealth, just buying another property doesn't necessarily, move the needle. You need to expand outside of those horizons. So I'll talk to you a little bit about some of those principles, but really, the concept of what I'm going to talk about today, dumbbell investing, the idea that you can put two weights on the edge of a bar. One weight of the bar represents a buy and hold portfolio, a very stable, safe, and sound system. On the other side of the bar, we can start to ratchet up our returns, carry a little bit more risk, and do something a little bit more adventurous. Really, the economic principle of dumbbell investment is very much in line with Harry Markowitz, which is one of the leading economists when it comes to basically modern portfolio building, the theory of creating a portfolio. What should it look like inside of that portfolio? Really, according to Harry, you've got to have some low risk things that are balanced out from sort of some medium risk assets to some higher risk concepts. So how can we win from higher risk investment in Australian real estate is really the conversation today. And I've just noticed my hat is fraying. I've got a fraying hat, a crinkly shirt. I've got a dot on my shirt, which I'm removing now. So YouTubers are probably switched off right now. They're like, who is this scruffy man? But hey, don't switch off, because we've got a lot to talk about. So how will I invest? I have covered off a little bit around this stuff over the last couple of weeks. But as you know, I think it's very important to balance your portfolio out. Now, in buy and hold real estate, balancing your portfolio is pretty simple. You can balance your portfolio by diversifying where you invest, even the states you invest in. And of course, you can diversify your portfolio with apartments, townhouses, houses, new properties, old properties. You can really create a blended diversification model. And I think really there are some powerful ways to diversify using land, location, and building quality inside of buy and hold real estate. But dumbbell investment is also the idea that on our bar of investment, we don't want just safe and sound investments. We also want to increase the risk profile to increase the return. Now, I would say if you bought a simple house in Melbourne, in Brisbane, in Newcastle, in Geelong, in Perth, you've got yourself a very safe and sound little investment property. That safe and sound investment property will do its thing. Leave it alone, put it away, save it for a rainy day. You literally just need to hold on to that little gold nugget. If it's in the right shape, if it's not going to fall apart on you, if it's not going to suck out your yield, you've got yourself a great little investment. As is the right high quality apartment, investment grade apartment, family friendly apartment. You've got yourself the right hold strategy. But what happens is as you buy and hold real estate, and as you maneuver and grow, and if you get into investment early enough, your wealth begins to compound. Really, there is a point where the principle of buying more buy and hold real estate is kind of not necessarily necessary. You've got enough to reach your end game. Now, remember, for a lot of people, the end game is pretty simple. They want some passive income in retirement. And of course, if you buy the right buy and hold portfolio and you watch it grow, it can perpetually continue to grow over time, both from a rental perspective and from a capital growth perspective. So quite often, for a lot of people, they'll get to a point where they've got bucket loads of equity and really start to struggle to even borrow more money to buy more buy and hold properties. And it's a good situation to be in. Quite often, those people can release some equity at the bank rate, 5-6%, and have it there as a redraw facility to do further investment with, whether that's in the stock market, the property marketplace, or an alternative investment class. But it's at a point, it becomes a little bit unnecessary to buy more buy and hold real estate. For example, some people start to get older in age, and when you get older, you have to look at your time horizons. When you're 58 years of age and you've got assets, do you really need another 30-year home loan to deal with? So this is where, again, Harry's economic model, modern portfolio theory comes into place. How do we balance a portfolio such as that? How do we unlock more wealth and more gains? And again, if we look at property investment and buy and hold real estate, it does its thing, but it's very much a long-term asset class. Anyone who buy and hold real estate for a short period of time, 1, 2, 3 years, is really speculating on the outcome. Sometimes they can win. If there's market corrections or downturns, they can lose with that attitude. So I like to dumbbell invest by having a sizable portfolio of buy and hold real estate, which will perpetually grow. But what happens is when you get a multi-million-dollar portfolio, it's easier to create capital growth. And what I mean by that, if you are starting out, you might have a $500,000 property, and for that $500,000 investment property to become $1 million, you need to watch that property basically go up by 100%. Even if you have $1 million property for you to see that $1 million property go from $1 to $2 million, it's 100% to make that $1 million mark. But what happens when you've got $3 million worth of real estate and you need another $1 million of growth? Well, all of a sudden, you don't need 100% capital growth on your money to make $1 million. If you've got $3 million of real estate magnifying in the marketplace and you want to make $1 million, you don't need 100% growth. You need whatever the percentage is, call it 30%. If you've got $10 million worth of real estate and you want $1 million to invest, $1 million worth of wealth, you just need the real estate market to go up by 10%. Now, markets over the last year, 2024, went up 10%. There were plenty of them. Brisbane, Perth, Adelaide, all went up 10%. Now, let's assume you had real estate in those areas to the value of $10 million. Well, you're already up $1 million. See, it's quite easy to use wealth when you're wealthy, and that's why we often see this today. There is really a great divide, the have and have not society. So the important part really is to start by building that buy and hold portfolio and make sure you give yourself enough time to also bring into your portfolio some more riskier ways to invest, some acceleration ways to invest. Now, I teach 7 plans when it comes to property investment. Your acquisition plan, which is your buy and hold plan. Your wealth acceleration plan is your exactly that, your way to take lazy equity and accelerate it and turn it into cash flow. There are 5 other plans: debt reduction, tax minimization, financial planning, there is property management planning, and one other, which I can't say right now because my mind has just gone blank. But hey, you guys get it. So really what we're doing here is taking 2 plans. We're taking our buy and hold acquisition plan and our wealth acceleration plan, and we're putting them at the edge of each other. And really we want to stack our portfolio with 70 to 80% buy and hold, but then with the other 20 to 30%, we want to start to accelerate, particularly when we've built wealth. This is not a good strategy for anyone who has no wealth. You need to go and build wealth, buy some great properties, capitalize on the next emerging trends in the real estate market. And I think I've said this in a recent podcast that if you are buy and hold investing, and I always buy and hold invest in every cycle, some of the trends I would look at is you've got a great structural shift unfolding with the intergenerational wealth transfer happening really over the next 2 decades. There's going to be a lot of money coming out of older people into the real estate market by virtue of inheritance. There's going to be a structural impact on the real estate market off the back of that. I would look at some investment strategy around buy and hold, whether houses, apartments, townhouses, all that kind of stuff. Affordable and livable pockets, I would be looking at houses. They've got to be very, very livable. They'll be in our outer suburbs. I would look at feeder cities, places like Geelong, Newcastle, where you can still get affordable housing matching to that millennial growth profile. Great way to invest. Sunshine Coast, Toowoomba, feeder cities are going to do really, really well over the next decade. And of course, the coastal areas of our major urban areas are going to do absolutely great, as will traditional blue chip urban areas, middle and inner ring suburbs of our major cities. They're going to do really, really well. You're going to get the result. Obviously, your job as a buy and hold investor is to work out how to leverage, how to borrow money, and how to deploy as much capital as fast as possible into the marketplace. Whether you think it's the right time to invest or not, The sooner you're in the market, the better off you're going to be. And that's why people often say the best time to invest was yesterday, the next best time is today, because real estate is all about compounding growth. Obviously, the caveat to that is you want to make sure what you invest in is investment grade real estate, that it's got the right factors of scarcity and influence behind it and the right factors of use to drive capital growth. Obviously, building a portfolio takes time. It's going to take a bit of time to become what is determined in Australia as a sophisticated investor. Now, typically, when you're deemed to be a sophisticated investor, you can do more investment stuff. And really, the Australian Tax Office and ASIC kind of govern what a sophisticated investor is. But effectively, you need a certain net worth and a certain series of wins from investment and also income profile to classify as a sophisticated investor. But once you're a sophisticated investor, you can do more sophisticated investments. And the reason that it is policed as part of really compliance and regulation is people shouldn't do risky strategies until they've built a buy and hold portfolio. So the whole system is set up to, in a way, actually support the concept of Harry Malkowitz's portfolio theory. Build your portfolio, start with low risk, and then eventually morph into riskier. Now, how do you balance risk and reward? Well, as I've alluded to, 70-80% of your portfolio needs to be buy and hold. But then when you've got lazy equity, which you can unlock, the bank will say, well, look, you got all this money. You want to use some of it? Like, what are you just sitting on it? Like a bush turkey? Don't be a bush turkey. We'll give you the money. You can borrow it from us at a low rate, whatever the bank rate is of the day, 5-6%. Go do something with it. Go start a share portfolio. Now, if you're obviously able to borrow, $100,000, whatever, at 6%, and then you go into the share market and you get a dividend of 7% and you get capital growth on your shares, well, you're making capital growth plus 1%. And really, that is the formula here. Now, I do this in real estate. Really, how to take action in that space is pretty simple. What is known as syndication. So what happens is, in real estate, people put real estate deals together. Professional people put real estate deals together. But quite often, they need to raise money to buy a site. And they're not running around with $5, $6, $7 million in their back pocket. So what professional real estate investors will do is they will speak to 10 other people and say, do we all want to chuck into buying a site together and develop it as a syndication, a joint venture, if you like. And so some of the bigger deals in Australian real estate just obviously have proportionately higher profits to them. There is ways to make money out of flipping Australian real estate at a local level, but it's very nuanced. Quite often to flip a buy and hold property, sometimes you have to be a renovator yourself. You have to take on a project. You have to do the work. You have to give up time going to your own job to focus on the project. As a syndicated operator, you tend to be very armchair based. You don't have to do too much. You just basically put your money into a syndication, and really that is based on other people's relationships. So if you've got a relationship with people that you can trust in that space, you start to be able to be exposed to opportunities. Now, I've done this with other investors over the last 5 years, really, as a strategy. just simply buying sites. What I typically do is I will join up with other people in my position and we'll go buy land, and then we'll do a land subdivision. So recently, we bought some land in Brisbane. It was one parcel of land. We turned it into 31 blocks of land. I'm just literally negotiating on another site up in Brisbane, which will literally turn into 50 blocks of land. Obviously, what happens is everyone in the syndication gets a win, and it's very much a spread, if you like. No different to taking the money from the redraw and borrowing it at 5%, investing in the stock market and getting 6%, same deal. The only difference is generally the returns are 15, 20, 25%. And again, the risk of those developments is anything to do with development carries a lot of risk. Developments can be delayed. Impositions can be put on developments. Council can have a bad hair day and make you get more reports than you thought. It's a little bit riskier than just buying a house and paying back the bank. There's a lot more moving parts. So in a syndicated group, there will be team members who work on the project, and really you're lining up to back those professionals to deliver an outcome and pay a return to the investors. And again, it's a great way to use lazy equity. And really, the best way to understand it is even de-risking inside of that space. The more money you have, the more you can de-risk that space. Instead of putting all your eggs in just one syndicate, you could spread money across 5 syndicates. So if you had, for example, $500,000, you can obviously use that money. Either it's cash or your bank is able to give it to you. It's not in your best interest to buy and hold real estate, or maybe you've got enough. So this is why you would be doing that strategy. And again, how to de-risk getting a return. Let's say each $100,000 gross got you a uplift of 20%. So each $100,000 is making you $20,000 per annum. If you had 5 syndicates going at once, you've got $100,000, basically making $100,000 out of the deal. If one deal basically gets 0 return because it goes sideways, gets delayed, there's problems with all sorts of hullabaloo, well then you've still got, rather than making no money out of out of the deal that's gone pear-shaped, or even not getting a return based on borrowing money out of the bank and basically copping it, the other 4 out of the 5 end up being profitable, and so you've de-risked your strategy that way, accelerating de-riskment. And again, that's really the concept of modern portfolio theory is, well, as you grow wealth, you take on more risk, you diversify that risk into different asset arrangements, and you start to really power forward. And again, this is how people take action to build some significant wealth later on, when they really don't want to put in the effort when it comes to creating generating wealth, like doing their own reno and so forth. And so what happens is, when you're deemed sophisticated, you can do this type of stuff. And it really comes down to your net wealth position. If you've got a decent level of net wealth, by law, you're allowed to do it. And so generally what happens is there needs to be a license holder, known as an AFSL holder, who also looks into your wealth, I guess you would say, and make sure that you're honky-dory to do these type of strategies. But as simple as it sounds, it's a great way to make extra money. And, I've got 5 of these things going at once at the moment. It's an extra 100 grand a year for what I borrow the money at is a great return. And again, you think about what you can do with that money. You can reinvest it and keep doing these type of strategies, or you can even redeploy it into further debt reduction strategies on other assets you have. So it's really the way of the world. And it really comes down to the fact that when you've got significant wealth, millions and millions in real estate, you need less capital growth to create wealth for you. When you've got very limited amount of assets in the marketplace, you need a large proportion of capital growth for you to end up being deemed as wealthy. So really the cornerstone of sophisticated developments, or sophisticated investing, I guess you would say, is getting over around that $2 million mark. When you've got $2 million worth of assets, you start to get accelerated capital growth because you just need less capital growth to function for you. And certainly as you go up to beyond millionaire to multi-millionaire to deco millionaire, you're just tapping money and you're able to deploy it at a rapid rate of knots. And again, the risk versus reward, would I suggest someone do what I just suggested instead of building a buy and hold portfolio if they do not have one? Well, absolutely not. The government would say no to you. I would say no to you. Go build your property investment portfolio. Everything needs a backbone. Everything needs a backbone. Anything that's flashy, that's speculative, it really is speculative in nature, whether it's speculating on crypto, whether it's speculating on syndicated joint venture developments. There is a level of speculation involved. Obviously, you can do your research and obviously, understand where the cycle patterns are and, make sure you're happy with the team involved and they're not going to run off with your money. I mean, that's the other thing with this type of stuff. There's a lot of people that will, are shonks out there. So, they're not profiles in the space. They're literally take your money and run. So, be careful of who you're doing business with as well, I would say. Look at their track record, look at their past performance, look at how long they've been in business for. If they haven't been around for decades, you probably have to question yourself whether, they're the right crew for you. But certainly it is a regulated space, and ASIC does watch it. So, yeah. But you don't want to dust all your dough in that space. You want to make some money in that space and you want to have a backbone. And that's how it works. That's sort of modern portfolio theory where you take high risk and apply it to low risk. And really what happens is by taking high risk and low risk, you actually create a nice middle ground of opportunity versus reward. And that's the beauty of the game. So have a think about it. All right, that's it for me. I'm off. Take care. Until next time, until we talk more property. That's it, over and out, and we'll talk more down the track. Uru. Thanks for tuning in to the Urban Property Investor. If you enjoyed the episode, make sure to subscribe on your favorite podcast platform or YouTube so you never miss an episode. I'd love for you to rate the show and share it with your family and friends. Let's spread the word about property investing. Stay connected between episodes on Facebook, Instagram, and LinkedIn. And check out the rest of our podcast network at positivementor.com.au. And if you're serious about growing your property portfolio, don't miss our complimentary Property Investor Nights. Register now via the link in the show notes. See you next time.